Hello everyone, this is Dr. Manoj K. Mishra from Department of Accountancy, Thakur College of Science and Commerce. I am here to discuss with you all a introductory chapter of SY BCom, second year Bachelor of Commerce degree, Sem 4, Profit Prior to Incorporation, which is also known as PPI. When I say PPI, so one thing comes to our mind, profit prior to incorporation. Means what do we mean by incorporation? And if it is so, if we are trying to understand what is profit prior to incorporation, so we also must be interested to know what is profit post to incorporation. So to understand the technicality of this PPI chapter, I'll take you to my screen and we will try to understand the technical aspect of our presentation. Profit prior to incorporation is the chapter which I'm going to discuss with you all. In the above image, it is clearly visible that uh, a person with so many hands, with so many tasks, and to handle all that task, he or she sometimes becomes uncomfortable due to shortage of finances. Because it is being said, finance is the lifeblood of any business organization and every business organization. So to handle the finances, they may be requiring some more fund. And to make this happen, I'll take an example. Let us assume business is sold to a company on January 1st, 2022. It is easy to understand. I have taken calendar year. Otherwise, these 12 months period is being divided or it's being understood in three pattern. Calendar year, which starts from 1st January, ends on 31st December every year. Then comes financial year, on which is also called as our the tax period, which starts from 1st April and ends on 31st March. And the third one is accounting year. There is no start and end specific day. A person or a businessman may start his accounting year on any random day, and very after completion of 12 months time, that is 365 days, the year comes to an end. It may start from 15th January to 14th January next year also. So there is no specific requirement for uh, calendar year, sorry, accounting year. So let us understand, the registration is going to happen on 1st May 2022. Because when I say profit prior to incorporation, so incorporation period is a period which require a lot of formality to be done so that a partnership firm becomes a company organization. When I say company, which is limited by shares, there is a huge scope of raising finance. There is different modes of raising finance, different types of finances capabilities gets opened up. So to get the benefit, the organization required to be registered as a company. And let us understand, as I said, 1st May 2022 is my registration year day, and 1st January 2022 is my starting year of the my accounting year. And as it is starting on 1st January, so it will end on 31st December, because 12 months is accounting is needed. But in between of the year, on 1st May, we are getting our organization getting registered as a company. So it's very much required to divide the total 12 months profit into two parts. What profit a partnership firm has earned and what profit a company is earning, because of tax calculations. Because a partnership firm or a other than company organization, the tax rate, tax calculation, tax methodology is different. And for a company organization, the tax rate, tax calculation, tax processes are different. So hence, we require to divide the entire profit of 12 months into two parts. So the process of dividing the profit prior to incorporation and post to incorporation is what we are going to discuss in this chapter. That is profit prior to incorporation. Because post incorporation is also there. So we'll see that in little detail. What is this chapter is all about? It says that profit prior to incorporation is the profit earned or losses suffered prior to company getting incorporated. When I say that, when I say that, it's required to understand कि the profit earned prior and profit earned post have a different terminology. The treatment is completely different. So to understand the treatment of pre and post, we are dividing our entire year's profit, the whole 12 months profit, into this two part. So profit earned after incorporation is your revenue profit, which goes to profit and loss account, which later, after adjusting other kind of expenses, is available for declaration of dividend. Whereas the profit earned prior to incorporation, prior part, is goes to your capital profit, which cannot be distributed to company to shareholders in the form of dividend. So hence this division is required. So I'll take you to my next example to make you understand. Profit up to commencement certificate. Commencement certificate is nothing but it is the day when the organization is getting commencement certificate. From this day onward, an organization is termed as a company, whereas prior to that, an organization is termed as an firm. It's very important to understand three dates. Date of purchase. When I say date of purchase means date of purchase of business, date of incorporation, and date of final account. So let us assume, which I have already given my example, 1st January 2022 is my starting date, 1st May 2022 is my date of incorporation, and 31st December 2022 is my final account date or year ending date. So the period up to date of registration is known as pre-incorporation period, and from date of incorporation up to date of final account, the period is known as post-incorporation period. And in our example, 1st January to 1st May comes to randomly 4 months, and 1st May to 31st December comes to randomly around 8 months time. So we can say that our time ratio is a ratio which tells us ki how our 12 months time is divided into two parts, prior to incorporation and post to incorporation. So which comes to 4:8 or simplified to 1:2. Period from first day of business up to the date of incorporation is our pre-incorporation, and post is period from the date of incorporation to the final account date is post-incorporation. Utilization of profit prior to incorporation, it cannot be distributed as dividend because the profit is to be treated as capital profit, and capital profit cannot be distributed as dividend. So here this profit can be used for writing of fixed asset if acquired, writing of goodwill if we have, writing of preliminary expenses if we have some startup expenses which we have incurred in the past, or paying interest to vendors. It can be used up because this belongs to the firm. Whereas the post profit is available with us for the purpose of dividend declaration, and it can be transferred to profit and loss account also. So the basic allocation, because when we are talking about the distribution division of available 12 months time, so we require to understand how to divide, on the basis of what to divide. So there are certain basic information which every one required to understand. Time ratio, as I have said, time ratio is the ratio which divides the entire 12 months time into pre and post. Second one is sales ratio. Sales ratio is the ratio which tells us profit earned up to incorporation and profit earned post incorporation. So many expenses which is variable in nature, which keep changing, which keep fluctuating, that gets divided as per sales ratio, whereas the fixed expenses, which is also called as period cost, the time bound expenses, they all the time bound expenses which remains fixed irrespective of level of operation, they gets divided into pre and post based on time ratio. So these two ratios, and other than these two, there are other information may also be there in the question. Like there might be rent division between two different parts, because in the question we may have the information that the rent rate prior to incorporation was different and the rent rate post to incorporation may be different. So we have to specifically calculate that. So specific ratio also we require to understand, to divide the available expenses which we have incurred for the entire year based on that specific information. There is the next ratio information is pre-period information. That is, there are certain expenses which a firm incurs, like partner salary, vendor's salary or vendor's interest. These things are belonging to the firm, and firm is your first column, that is pre-incorporation column. So that will be absorbed in the pre-column, whereas my second part is post-period. Post-period, the expenses or the income which is only possible for a company to incur, that gets absorbed in only in post column, like director's fee, director's traveling. There are certain expenses, certain examples given to make it understand. So these expenses are those which gets incorporated in only post column. There are certain procedures, certain steps to solve the problem. As far as the format profit and loss account is concerned, it required to have certain columns of pre-incorporation expenses, post-incorporation expenses, and income also. Then the starting point of our solving this problem, it starts with gross profit, which we absorbed in pre and post in sales ratio. When I say in sales ratio, which we have already calculated, because when we start the question, the first two primary calculation which we have to do, first is calculation of time ratio, that will tell us how much months expenses will be there in first column and how much months expenses will be in the second column. So once the time ratio is known, based on time ratio we divide the sales ratio. We understand, we calculate the sales ratio, because fixed expenses and variable expenses, both type of expenses and income, we are going to divide in pre and post column. So it required to be known as on primary basis. So allocating gross profit ratio in sales ratio, or the ratio which the information has given in the question, depending on absent information, depending on if there is no clarification in the question. So the sales or some certain information may be there in the question, so that gets absorbed, used up for calculating ratios. All the fixed expenses are to be taken on time ratio, which I have told you. They are those expenses which is time bound. वहां पे activity is not important. The time spent in pre and time spent in post is important. Then all the expenses which is variable in nature, which keep fluctuating. Fluctuating, when I say, that is related to sales. More sales, more expenses. Less sales, less expenses. So those expenses or income will be absorbed in pre and post on the basis of sales ratio. There might be some other information depending on that, as I have told you, like rent ka, then some kind of other specific information, some other detailing have been given about a particular expense or income, so that will be absorbed accordingly. The expenses which only goes for the pre column, there are certain expenses which I have already told you. There are certain expenses which only a firm incurs, so they will be recorded only in pre column. At that same time, there are certain expenses and income which gets recorded only in post column. So these expenses and income we require to calculate, and at the end of calculating my posting my all the expenses and income, when I total my profit and loss account, the end result is capital reserve or goodwill in pre-column, net profit or net loss in post column. So we try to understand how all these things are concerned. The profit earned related to post incorporation need to be transferred to appropriation account. This is, we are going to discuss about the format which is going to help us. Yeah, this is the statement of profit and loss account for the year ended, which consists incomes and expenses. When I say income, it's a gross profit, rent received, share transfer fee, and other type of informations. So depending on information, the that expense or income will be divided into pre and post. So as I said, certain information in pre and post, there are certain expenses, a list of expenses in fact have been given here, and those expenses are absorbed in pre and post column. The difference after totaling, after taking these total at the end, whatever remaining answers are there, so those remaining informations are being uh, recorded in pre and post column, like salaries, which is a time ratio, rent, taxes, insurance, interest, repairs, establishments expense, depreciation, audit fees. A list is long to read. So these expenses, which is completely time bound expenses, they will be distributed in pre and post on time ratio. There are certain expenses which is related to my sales. More the sales, more the expenses, less the sales, less the expenses, and pre and post. So though they will be recorded as per sales ratio. I'll take you to my next slide. There are some other important aspect of PPI also, like audit fee, the accounting charges which we say. Audit fee is the fee which is payable to auditor, the chartered accountant. There is statutory audit, different types of audit uh, which are available for a company. So depending on that, we require to compensate the auditor with a fee. So audit fee will be divided into time ratio. It also can be taken to post ratio depending on our assumption, guys. Because accounts is based on assumptions. With the correct assumptions, with the logical point, the things can be considered in purely post column also. Preliminary expenses or losses, they are those which is also termed as startup expenses. At the incorporation time, there are certain expenses which an organization have to incur before they have started earning profit. So those expenses require the adjustment, they directly goes to the post column because it is related to company. Again, dividend is something, a reward which is payable to shareholder, which is the which is a criteria to a company. So hence dividend will also be taken in the post column, guys. Provision for tax, it will be taken in pre and post, or post also, depending on the information which is given in the question. Purchase consideration and payment of purchase consideration, this is the additional information which may be given in the question, which tells that certain expenses, certain information, certain items are absorbed. Like when I said at the beginning in my first slide, I've told you that let us assume the firm is getting sold to a company. When I say sold to a company, so the sale will require a consideration payable, a payment payable. So that payment information sometime given in the question, depending on on a particular day the payment is done. So here for settlement of interest of purchase consideration, PC amount, or some other related information to PC, we require to calculate a specific ratio. When I say specific ratio, that we require to calculate, that may be different from question to question. So interest on PC, which I was just discussing about, depending on the date given when we are when we are doing the settlement of PC, this interest on PC is recorded or distributed. So date of purchase or date of conversion is very crucial for the calculation of PC, because from that day we consider the PC becomes due for payment. And date of incorporation, the date when the company company is getting incorporated or getting registered as a company. The date of payment of PC is also crucial, because that all the three information are being considered to find out what will be our interest on PC date. For calculation of time ratio, following dates are very crucial: date of purchase, date of incorporation, and date of final account, which I have already at the beginning also informed, because these three dates are very crucial, and these three dates may differ from organization to organization. It is not necessary every organization is going to follow calendar year. Every organization is going to follow account financial year. If there might be organization who may continue as an accounting year, which may be completely different from calendar and financial year. So there is whatever date is given in the question, from that date we have to count the 12 months time, and the 12 months time will be taken into consideration for finding time ratio, which is our the first and foremost uh, details. For calculation of time ratio, date of certificate of commencement of business should be ignored. That's very crucial to understand, guys, because when I say calculation of time, date of certificate of commencement of business is different. Certificate of incorporation is important for us. Incorporation is the day when the company is getting recognized, and commencement may happen latter period also. May happen latter. So incorporation is important. Commencement means I got the certificate incorporation, but I am continuing as a company after some time. But the calculation of profit and loss, the expenses and income division has been already started. The moment I got the certificate of incorporation. So from that date, my all calculation, all the period post will be counted as post period, and the information and the period which is in pre column is pre incorporation period. Expenses which only company can incur are charged only to the post profit, that is the post period, that is the director salary or the uh, uh, preliminary expenses, or those expenses which a company can incur. Expenses charged by vendor are charged in pre period. All expenses related to partner, when I say vendor, the old organization, the organization who is selling. So these things are very important to understand, guys, because with this we can continue with our sums. So this is the introductory part which everyone required to understand. Profit prior to incorporation, profit post to incorporation period, these both the periods, profit is very important to understand for an organization, because based on that their tax calculation is being done. Thank you. Have a good day.